Hello, friends. Very good evening, all of you. How are you? So, today, let us start learning working capital management in CA Intermediate Financial Management. And in that, we have estimation of working capital using operating cycle, estimation of working capital using pro forma, like current assets minus current liabilities. And after that, very important area is management of accounts receivable, or we can also call it debtors management. It is debtors management or management of accounts receivable. So we also have inventory management in this chapter. We also have some theory like how do we finance working capital required, all these concepts. But as far as examination is concerned, the first important area is working capital estimation. And another very important area from working capital management is management of accounts receivable, wherein we evaluate different credit policies and we advise the company go with this credit period or go with this credit policy. So these are very important questions. Management of inventory, normally we do not teach in financial management because calculation of EOQ, then all the other dimensions of inventory management are similar to our costing subject. Okay, so whatever you have learned in cost and management accounting, with respect to inventory management is same in financial management also. There is absolutely no difference. And then there is also another area called management of accounts payable, which is creditors management, which is pure theory. That is not important from exam point of view. And even if you open ICI study material, it is just some basic understanding. Then there are certain areas like factoring, cash budgets, cash flow management. So these are what we call miscellaneous areas. Okay. So today in this important area, working capital management, we are going to focus on debtors management. Okay. So if you are ready, we will start. So I'm starting with some basics and basic questions. So my question number one is, I am writing certain statements on the screen. What you need to do is you need to read the statement and answer my question in the chat box so that, I always want my class to be interactive. When you are interacting and when you are responding to my questions, it gives me an understanding or the assessment of your reception or your understandability, based on which I, change the frequency of my delivery. So for your benefit, please participate extensively. Okay, so what I'm writing here is point number one. Those entities who sell goods or services on credit only will have debtors. That means if you are selling on cash, you don't need debtors management. Is it right? Right or wrong? Excellent. Everybody is saying right. I'm very happy. I'm very happy. So step one, debtors management is applicable only to those entities who sell goods or services on credit. Okay. Point number two. If we extend credit, if an organization extends credit to its customers, sales will increase and profits also increases. Profit also increases. So do you agree with me? Yes or no? For second point, yes or no? If we extend credit, more people will buy, sales will increase. So obviously, along with sales, profits also will increase. However, it has certain challenges also. However, it has certain challenges also. So can you tell me what are the challenges an organization faces when they sell goods on credit? When we sell goods on credit, what challenges? So Anu is saying bad debts. Okay, excellent. So I'm writing A, bad debts. So there is a risk of bad debts. Okay, then anything else? So Liana is saying administration charges. True, that is also correct. Liana is saying administration charges. That is also correct. B, administration charges. Credit administration charges. Then anything else? Then Liana is saying opportunity cost of investment, minimal cash inflow. Rajesh is saying minimal cash inflow. Okay, so C, shortage of cash or cash inflows. Okay, very good. Then Liana is saying opportunity cost of investment in debtors. I agree with that. Excellent, excellent. So I'm writing my third statement here. If an entity sells goods on credit, they will have debtors. Debtors increases the requirement of working capital. So the companies short-term liabilities in terms of overdraft or short-term loans to finance working capital needs will increase, which ultimately increases interest cost or opportunity cost. So I have written my third statement here. Can you please go through that and let me know in the chat box? Do you agree with me or no? Do you agree with me? If an entity sells goods on credit, their debtors will increase. When debtor increases, current assets will increase. When current asset increases, working capital requirement will increase. If working capital requirement increases, you need to borrow more money, you need to use more overdrafts, you need to have more short-term loans, or you need to use more reserves towards working capital. And all these things will increase your interest cost or opportunity cost. Do you agree with me? Can you please let me know in chat box by way of yes or no? So Liana is saying agreed. Very good. Excellent. I'm happy. What about others? Lalita is saying yes. Rajesh is saying yes. Okay. No. 4. Debtors management or management of accounts receivables is to maximize is to A, maximize debtors, B, minimize debtors. So what do you think is correct answer? Do you think A is correct answer or B is correct answer? Debtors management or management of accounts receivable? What is the objective? Shall we maximize debtors or shall we minimize debtors? Liana is saying balanced. Oh my God, this is a good answer. What about others? Guys, do you think debtors have to be maximized or minimized? Or C, optimum amount of debtors. So maximum debtors you want or minimum debtors you want or optimum debtors you want? Now see, everybody is saying optimum. So optimum debtors are the debtors where the profit is maximum, but the associated costs are minimum. So optimum debtors is the amount of investment in debtors where A, benefits like profit are maximized and associated costs like bad debts, okay, like bad debts, credit administration costs, credit administration costs, opportunity costs, are minimized. So do you agree with fifth point? Read fifth point, and if you agree with me, say yes. Optimum debtors is the level of debtors, is the amount of debtors where you try to maximize your profits. Simultaneously, you keep an eye on the associated costs and you want to minimize the costs. Do you agree with me? Excellent. Excellent. Now, shall we do some basic mathematics? Shall we do some, exercises, small, what we call warm up exercises? Question number one. A company's annual sales are a company's annual sales are 10 crores, and out of which the credit sales are 75% of its total sales. Calculate its credit sales. Calculate its credit sales. I don't know answer. You have to tell me the answer. So can you give me answer for question number one? I'm waiting for your answer. Hey, come on. Easy answer. Yes. Credit sales is equal to total sales into 75 divided by 100, which comes to rupees 7 crores 50 lakhs. Credit sales, 75% of total sales. So credit sales is 10 crores into 75%, which is 7 crores 50 lakhs. Okay. Now, question number two. The company allows a credit period of the company allows a credit period of 30 days. Assuming a year consists of 360 days, calculate its debtors. Calculate debtors. This is question number two. I want your answer. Answer for question number two. Debtors is equal to credit sales into credit period divided by 360. Okay. So that is equal to 7 crore 50 lakhs into 30 by 360. That is equal to so someone has given wrong answer to me. Okay, very good. Gayatri is saying 62 lakhs 50,000, correct. Saranya, correct. Liana, correct. 62 lakhs 50,000 is the correct answer. Okay, this is correct answer. Very good. Shall we go to question number three? Question number three. If the above company requires a return on investment of 20% on its debtors, what is the opportunity cost involved? So the company requires 20% return on investment on its debtors. Now you tell me what is the opportunity cost. So take debtors, multiply with rate. Saranya is saying 1.5 crores. No, 1.5 crores. I don't know. Is equal to 62 lakhs 50,000 into zero point 0.2. So it is 12 lakhs 50,000, ma. It is 12 lakhs 50,000. Very good, very good. Now everybody is giving correct answer. 12 lakh 50,000 is correct answer. Okay. Now question number 4. So question number 4 is concept based question, not numerical numbers based question. Calculation of debtors in management of accounts receivable is required to calculate opportunity cost. Do you agree with this? Yes or no? So we are writing statements. So we have written 5 statements. Now I'm writing 6th statement. This is not question number 4. This is 6th statement. My 6th statement is calculation of debtors in management of accounts receivable is required to calculate opportunity cost, but not for financial reporting or accounting purpose. We are not doing this for accounting. We are not doing this to do something to your financial statements. So management of accounts receivable will not influence your P&L balance sheet. It influences your decision making. That's it. Should I extend credit or no? Should I have more liberal accounting, liberal collection policy or no? My current credit period offered is 30 days. Shall I go with 40 days or shall I reduce it to 20 days? Shall I have more stringent collection period or shall I extend more credit period? So, considering the competition, considering the external factors, should I increase the credit period? Should I decrease the credit period so that I will, strengthen my business for my competitive advantages? Now, you tell me, do you agree with me if I say this debtors management is not for accounting, it is only for decision making? Do you agree with me? Yes or no? Yes or no? Yes or no? Super. Because it is not for accounting, there are certain peculiarities in calculations, and that is 7. That is interest on debtors, which is also known as opportunity cost. Interest on debtors, which is also known as opportunity cost, is calculated not on debtors, but on cost of investment in debtors. Which means debtors are not calculated based on sales or selling price. Rather, debtors are calculated either based on a total cost, which includes variable cost plus fixed cost before bad debts and taxes, or B, variable cost. First one is called total approach. Second one is called variable cost approach. So debtors are calculated either based on total cost. Sometimes, see, why students are more confused in financial management than accounting paper. So I teach accounting, advanced accounting. I teach financial management, but students feel more comfortable in accounting than FM. I'll tell you the reason. The reason is accounting is pro forma based. Accounts is pro forma based. So if you do one accounting treatment in question number 1, the same accounting treatment probably you'll do in all the questions. Because there are legal compliances, there are accounting standards, there is strict guidance given that it should be done like this. But when it comes to financial management, it changes from industry to industry. The way how, decisions are made, calculations are made, decisions are taken based on the financial statement numbers from one industry to another industry, from one company to another company, from one country to another country changes. For example, when you are calculating debt equity ratio, when you are calculating debt equity ratio, in some countries, debt equity ratio up to 2 times is allowed. In some countries, debt equity ratio up to 0.5 only is allowed. In some countries, we calculate debt equity ratio in terms of number of times. In some other countries, we calculate debt equity ratio in terms of percentages. So in some countries, debt equity ratio is calculated only using long-term debt. In some countries, debt equity ratio is calculated using total debt, means long-term debt plus current liabilities also. So students are confused. Pavan sir, I have read that question, answer is different. And in this question, answer is different. You need to understand the concept. Similarly, when you are studying debtors management, debtors can be calculated on sales, debtors can be calculated on total cost, debtors can be calculated on variable cost. Ideally, debtors should be calculated on variable cost. Ideally. But in some problems, debtors are calculated based on total cost. But never, if you are doing CA Inter, CMA Inter, CMA India Inter, there are, different dimensions. They calculate debtors in a different way. But as far as CA Intermediate, Institute of Chartered Accountants of India courses are concerned, normally in debtors management, to calculate return on investment, we calculate debtors based on variable cost in 90% of problems. Sometimes debtors can also be calculated based on total cost. Now, let us see what is the meaning of this. Now, I am writing question number 4. We have solved already 3 questions. So I'm writing one more scenario on the board. Will you calculate and give me the answer for question number 4? Say yes if you are ready. Very good. Total sales, rupees 25 lakhs. Credit sales out of total sales is 80%. Variable cost ratio is 65%. Fixed costs are rupees 3 lakhs. Rate of return expected on debtors is 20%. Calculate opportunity cost based on A, total approach, B, variable cost approach. I want your answer. Ta-da! Very good. Credit period. 1 second. Credit period is 30 days. Credit period allowed is 30 days. Shaima. Shaima is asking variable. What is variable, ma? Total sales 25 lakhs. Credit sales, which is 80%, is take this number. So credit sales is 20 lakhs. Credit period is 30 days. So debtors. Credit period 30 days. Liana has already come up with answer 1,60,000 for 16.67, 1,35,416.67. Amazing. Investment in debtors. Yeah. On total cost, it is 20 lakhs into 20 lakhs into no sales 20 lakhs less variable cost is 65% is equal to, I'm taking this number into 65%, 13 lakhs. Fixed cost is 3 lakhs. Total cost is 16 lakhs. Investment in debtors based on total cost. Return on investment in debtors, or this is also known as opportunity cost. This is also known as opportunity cost. Based on total cost, it is 16 lakhs into 30 divided by 360 into 20 divided by 100. Okay. Based on variable cost, it will become 13 lakhs into 30 divided by 360 into 20 divided by 100. So these are the answers. So let us see if your answers are correct. No, you have given some other answer, but I am getting some other different answer. So the answers are opportunity cost when you calculate debtors on total cost approach. Opportunity cost here is 26,667. When you are calculating it based on variable cost, it is 21,667. Are you with me? I'm very happy you're participating. Doesn't matter if your answer is wrong. Doesn't matter if your answer is wrong. If your answer is wrong, that is still fine. We are all students. We are learning. So it's okay to calculate mistakes. Do you understand the concept? Very good. Very good. Question number 4. Now, question number 5. Question number 5. Debt collection period. Average collection period from debtors is 90 days. If a year consists of 360 days, what is debtors turnover ratio? Average collection period from debtors is 90 days. Year consists of 360 days. 1 year consists of 360 days. Calculate debtors turnover ratio. So I'm writing debtors turnover ratio 6 times. Do you agree with me? My answer is right or wrong? Very good. Vidya, your answer is correct. It is 4 times. Debtors turnover rate is equal to 360 divided by average collection period. That is equal to 360 divided by 90 days. That is equal to 4 times. Question number 6. If the debtors turnover rate of A Limited is, if the debtors turnover rate of A Limited is 2.4 times, what is its average collection period from debtors? If the debtors turnover rate is 2.4 times, what is the average collection period? Hello, I need answer. Vidya is saying 150 days. Anu is also saying 150. Ramya is also saying 150 days. Saranya is also saying 144 days. All girls are only giving answers. Shameless boys, where are you? Oh, Anil said 150 days. Very good. Saranya, how come you got 144? Have you taken 365 days in a year? Lalita is saying 150. Correct. Answer, Rajesh. Correct. Answer. Average collection period is equal to 360 divided by 2.4 times. That comes to 150. That's fine. Saranya is saying 360 days, 360 days. That's fine. No problem. I'm happy you have done the answer. The procedure is correct. Okay. So shall we do ICAI problems now? Are we ready to do ICAI problems? Okay. So they have given what is the meaning, objectives, then aspects of management, what is credit policy, what is credit analysis, control of receivables. So all this is theory. What are the factors determining credit policy? Theory. Factors under the control of finance manager, again theory. Now, approaches to evaluation of credit policies. From here, problems, numeric questions start. There are basically two approaches of evaluating the credit policies to be adopted by company. One is called total approach. Okay. One is called incremental approach. What mental approach? Incremental approach. That means it is some mental approach. No, it is not mental approach. It is incremental approach. Okay. The formats for two approaches are given as under. Then they are telling this statement showing evaluation of credit policies, total approach. So they are giving particulars column. Very good. Present policy in one column and proposed policies, policy A, policy B, policy C, or policy 1, 2, 3, 4, whatever the policies are, they are in columnar manner, different columns. So they are taking A, expected profit. How do we calculate expected profit? First, take sales given in the question. Okay. From that, reduce variable cost and fixed cost. So if you reduce both, it is total approach. What does it mean? Now, imagine if variable cost is 100 rupees, if fixed cost is 50 rupees, total cost is 150 rupees. For calculation of debtors, will you consider variable cost 100 or will you consider total cost 150? That is the question. If you are following total approach, we'll take 150. If you are following variable cost approach, we'll take 100 only. So in different questions, how do we do it in different manner? I will explain. Don't worry about it. Don't worry about it. Then they have taken bad debts, If at all discounts are there, they have subtracted discounts. So from credit sales, if you subtract variable cost, fixed cost, bad debts, and cash discount, that is what we call profit before tax. Estimated profit before tax. And then subtract tax, you'll get expected profit after tax. So this expected profit after tax is before opportunity cost. Now you need to calculate opportunity cost. How do we calculate opportunity cost? Total cost into average collection period divided by 360 into rate of return required divided by 100. That is how we calculate opportunity cost. So how do we calculate opportunity cost? Right here. How to calculate opportunity cost? A, based on total cost approach. Based on total cost approach, opportunity cost is equal to total cost. What is total cost? Fixed plus variable into average collection period, credit period divided by 360. You can take 365 also based on the question into rate divided by 100. It is opportunity cost if you are doing it in total approach. B, based on variable cost approach. Based on variable cost approach, opportunity cost is equal to, we will change only one thing. Instead of total cost here, you will take variable cost. That's all. Basically, if you understand, this is your investment in debtors. This is your investment in debtors. This is what we call investment in debtors, cost of investment in debtors. On that applied rate, it becomes opportunity cost. That's all, simple. Guys, do you understand A and B? If you understand A and B, say yes in the chat box. Superb. So they have taken expected profit. From expected profit, they subtracted opportunity cost. Expected profit minus opportunity cost is your net benefit. Is your net benefit. That's it. Now we'll solve one problem. This question, this illustration number 1, ICI has done in 2-3 different methods. So we'll solve in all the methods. We'll solve in all the methods. So can someone turn on the mic and read question number 15, which is practically question number 1 here. So Lalita, is your mic available? Lalita, madam.
Yes, sir. Good evening, sir.
Very good evening, ma. Where are you from?
I am from Eluru.
Eluru. Aha.
Yes.
Very good. Read.
A trader whose current sales are in the region of 6 lakhs per annum and an average collection period of 30 days wants to pursue a more...
Hold on. Hold on.
Okay,
So
sir.
his sales are 6 lakhs, average collection period 30 days. Can you calculate debtors?
A trader whose current sales are in the region of 6 lakhs per annum and an average collection period of 30 days. 6 lakhs per annum. 6 lakhs into 30 divided by 360. 50,000.
How much?
50,000.
Okay. Now let us ask our audience whether 50,000 is correct. 50,000. Correct. 50,000 is correct or wrong? Hey, all remaining people, tell me, she said debtors 50,000. Is it right? No, it is wrong answer.
Okay.
Why?
6 lakhs per annum. Average.
6 lakhs is sales, akka. We will calculate based on. Saranya is saying credit sales. No, it is not about credit sales or total sales. It is about how can you calculate debtors on sales. Debtors are to be calculated on cost basis. In debtors management, you take cost of investment in debtors either on total cost or on variable cost. So take
Okay.
total cost. See, how did we calculate? How did we calculate? Pawan sir, take total cost into do something, correct. Take variable cost into do something, correct. But sales into something, no, that is wrong. Rule number 1, in debtors management, never calculate debtors on sales basis. Debtors are to be calculated on total cost or debtors are to be calculated based on variable cost. Clear?
Okay.
Okay, very good. Continue.
On collection period of 30 days, wants to pursue more liberal policy to improve sales. A study made by a management consultant reveals the following information. Credit policy A, 10 days increase in the collection period. It will increase the sales by 30,000. Present default anticipated by 1.5%.
So can I say that the last column is bad debt rate?
Yes, sir.
Okay.
And by credit policy B, increase in the collection period by 20 days, increase in the sales will be by 48,000 and the default anticipated 2%. And by credit policy C, increase in collection period 30 days, it will increase the sales by 75,000 and present default anticipated by 3%. The credit policy of D, it will increase the collection period by 45 days and it will increases by sales 90,000 and default anticipated 4%. The selling price per unit is 3 rupees.
Hold on. Total sales 6 lakhs.
Okay.
Selling price per unit is 3. Can you tell me number of units sold?
6 lakhs divided by 3 rupees.
Yes. How much it is?
It is 2 lakh units.
Okay. Very good. So I'm writing illustration number 1 or illustration 15 as per ICI. Working notes in that annual sales in rupees is 6 lakhs.
Yes, sir.
Selling price per unit is 3
rupees.
Number of units sold is this divided by this 2 lakhs. Very good. Continue.
The average cost per unit is 2.25 paise and variable cost is rupees 2. The current
Wait. Hello, wait. Average cost 2.5, variable cost 2, number of units sold is 2 lakhs. Can anyone calculate and tell me what is total fixed cost?
Total fixed cost 2.25 0.25 into 2 lakh. 0.25 into 2.25 lakh into 2 lakh units is equal to 4,50,000.
Anil is saying 1.5 lakhs. Babu, Anil.
4,50,000. Total cost will be 4,50,000.
ఏంటక్క 2 lakhs into 0.25 is 50,000 akka.
Yes, sir.
Vidya is saying 50K. Correct, Vidya. Anu is saying 50,000. Correct, Anu.
Yes, 50,000.
So do you agree with me?
Yes, sir.
Okay. If any student is not able to understand, how do we calculate fixed cost 50,000? What to do?
Total cost will be 2 lakhs into 2.25. That will be 4,50,000. Variable cost is 2 rupees per unit, that is 4 lakhs. If 4 lakh 50,000 less 4 lakhs, it will give the fixed cost, it is 50,000.
Correct. Normally, what I do is, if any student is not understanding simple calculation, I'll tell them, if you do not understand this, go to 7th floor and jump from there. But I changed my approach. I started being nice to students. And if you are not understanding this concept, read once again, solve it once again. That's all. Don't go to 7th floor and jump. Maybe your mother, father are having only one child. So are we done with this?
Yes, sir.
Shall we go back to question?
Yes, sir.
Continue.
The current bad debt loss is 1%.
Can you tell me what are the bad debts?
Or unable to collect
Correct,
the
ma. How much? How much is bad debts?
6 lakhs into 1%.
How much are they?
6,000.
Correct. Continue.
Required return on additional investment is 20%. Assume 3 days per year. Required return on additional investment is 20%. Unless which of the above policies would you recommend for adoption?
Very good. Shall we solve this question?
Yes, sir.
Okay. So all of you look here. Statement showing evaluation of alternative credit policies of XYZ Limited. If the company name is given, we'll write company name. Otherwise, we'll write of a trader. That's it. Okay, so we'll do particulars column. This is present column. This is proposed credit policy A. This is credit policy B. Credit policy C. Credit policy D. Credit policy A. Done. So one present column and 4 future columns. Then we write first sales, or we'll write credit period. So what is present credit period? They have given 30 days. Present 30. Credit period in terms of days, 30. Okay, so CPA, can you tell me, Lalita, CPA, how much, ma?
Current credit policy of 30 days.
A, ma, A. Credit policy, A, how much?
10 days. 10 days, 30 days plus 10 days. It will be 40 days.
Very good. 40. Then D.
50 days.
Very good. Then C.
80 days. Sorry, 60 days. 30 plus 30 days, 60 days.
Very good. D.
30 plus 45. 30 plus 45, 75.
40 plus 45, 75. Okay, so shall we put one total column here and add all the numbers? No, that is wrong. Credit period. Okay, now sales. So they have given sales 6 lakhs. Here I'll write 6 lakhs. So CPA, how much?
6 lakh 30,000.
Very good. Next.
6 lakh 48,000.
Very, very good. Next.
6 lakh 75,000.
6 lakhs 90,000, last one. Correct?
Yes.
Variable cost, how much? So here what we do is, we can do one more step for you. I'll write one more step for you. Number of units sold. Okay. We know that selling price is rupees 3. So this is sales. So can I say number of units sold is this divided by 3? So 2 lakh units at present. And this is number of units sold column. Pavan sir, do I need to write that column? Even if you do not write that column also, you can calculate variable cost. Simple. Variable cost is 2 rupees out of 3. So I can write it is equal to 2 by 3 into sales.
Yes.
Either you can calculate like this, or variable cost is 2 rupees per unit sold. total number of units sold is 2
into
lakhs. So you can write simply is equal to 2 rupees into number of units sold.
Yes.
Do you agree with me?
Yes, sir.
Okay. Now here, how much I need to write?
2,10,000 into 2 rupees, that will be 4,20,000.
Next.
4,32,000.
Next.
4,50,000.
Next.
4,60,000.
Very good. Now fixed cost.
Fixed cost will be same 50,000, 50,000, 50,000.
Very good. 50,000. How it is 50,000? We have already done working note 1.
Yes.
So fixed cost will not change. So it is 50,000. So total cost before bad debts.
Yes.
How much?
Total cost 4,50,000, 4,70,000,
Then
4,80,000, 5 lakhs, and 5,10,000.
super. So this column will be used to calculate opportunity cost. That means we are doing it based on total cost approach. If you are following variable cost approach, you will calculate opportunity cost on this line.
Variable cost.
So green line, variable cost approach.
Variable cost approach.
Yellow
This
line,
will be
total cost approach.
total cost approach.
That's all. Okay, now bad debts percentage. Bad debts percentage. So present, what is bad debts percentage? 1,
It will be 1%.
present 1. Then in
Yes,
future,
sir. It will be increasing.
1.5%. Then 2%, 3%, 4%. Correct? No, bad debts rupees is equal to credit sales, or you can take
Yes.
total sales in this question
Total
because
sales.
we do not know credit sales, cash sales. So we are taking total sales into bad debt rate.
They have 6 lakh.
Okay, here 6 lakhs. Then
6 lakh 6,000.
here how much will come?
6,000.
6,000.
9,004.
Second column.
9,450.
Very good. Next column.
6,48,000 into 2%. 12,960.
Hey, you are looking at textbook and telling answer, or you are calculating it?
No, sir, I'm calculating here, sir.
Promise.
Yes, sir.
Mother promise.
Mother
Pinky
promise.
Pinky promise.
Yes, sir.
You're not cheating me, no? Okay.
6,75,000 into 3%. 20,250.
Mm-hmm.
6,90,000 into 4%. 27,600.
Mm-hmm. So this is bad debts. Do we have any other cost in the problem? No, that's all. So we have considered all the costs. So this is sales, this is variable cost, this is fixed cost, this is total cost, this is bad debts, and all our numbers are correct. Now we will calculate expected profit. Okay, now look carefully. I am taking sales minus, I am subtracting total cost. Sales, I am subtracting total cost. And
Less
then I am
bad.
subtracting bad debts. So this
Okay.
is what we call expected profit. This is what we call expected profit.
Expected.
Okay. Expected profit. So can you tell me what is expected profit for policy A, policy B, policy C and D?
6,30,000. 6,30,000 minus 4,70,000
Oh,
minus 9,450.
okay.
One lakh
Next.
50,000 550.
Okay. Next.
6,48,000 minus 4,82,000 minus
Okay.
1,53,040.
Mhm.
1,53,040.
Okay. Guys, all the
75,000
remaining students in the class, please calculate and tell me answer in chat box.
plus total cost 6,75,000 minus 5 lakhs minus 20,000. 1,54,750.
Very good. Hello, remaining people. Vidya, Anu, so many others we have. Abhila, Anil, Saranya, Rajesh, Ramya, Vishweshwar, Sonia, Jalaluddin, Dilshida. What all you people are doing? Liana.
1,50,400.
Very good. So this is expected profit. Now we need to calculate opportunity cost. Working note 2. Okay. Now we'll write working note 2 here. Calculation of opportunity cost. How do we calculate? We'll take total cost column into credit period divided by 360 into what is the rate of return required in the question. In the question they said the rate of return on
20%.
debtors is 20%. So they want 20%. Okay. So we'll take 20%. Okay. Present. Present. How do we calculate present? 4,50,000 into 30 divided by 360 into 20 divided by 100. How much?
7,500.
Credit period A. Credit policy A. Then 4,70,000 into 40 days. 4,70,000 into 40 days divided by 360 into 20 by 100. Credit policy B. 4,82,000. What is credit period, ma?
Credit period is
50 akka. Credit period is 50 into 360 divided by 360 into 20 by 100. Credit policy C. 60 days, 5 lakhs. Hey, I want answers from all of you in the chat box. Credit policy D. Total cost is 5,10,000 into, is it 75 days, ma?
Yes, 30 plus 40.
Tell me. Now calculate and tell me what is this.
21,250.
So is it 7,500? First one?
10,400. 10,444.
Okay.
52,000.
Okay.
13,389. 16,667.
Saranya is saying 10,711 rupees. I did not get it anywhere, ma. Why? My answer is wrong or your answer is wrong? Lalita, are my calculations correct?
Yes, sir.
Are you sure? Okay, so opportunity cost, we'll take 7,500 here, 10,444 here, 13389 here, 16,667 here, 21,250 here, and this is what we call A, estimated profit. This is what we call B, opportunity cost, and net. Saranya is saying mine, sorry, as usual. I like it. I like the spirit. Okay. Net benefit C is equal to A minus B. And
1,36,500.
okay.
1,40,106.
Okay.
13 1,39,651.
Uh-huh.
1,38,083.
Uh-huh.
1,31,150.
So this is our answer. Now, based on this, we need to write conclusion. Which policy is better? You tell me. So first, let us check the answers. 136,500, 140, 106, 139, 651, 138,083, 1,31,150. So our answer is correct. So
B.
which policy is better?
Present policy A, sir. 1,40,106.
Vidya has written B and then she edited it to A. Oh, hello, we know something called audit trial. Even if you are manipulating, we'll find you. Conclusion. It is advisable to adopt credit period of 40 days credit policy A since the net benefit is maximum. That's all. So guys, all of you, do you understand this question? In the chat box, please let me know by way of an yes or a no. Tell me. So guys, do you understand this? It's okay. It's okay. Very good. So this is what we call total approach, and there is also something called incremental approach. Now the same question is calculated in incremental approach in second pro forma. So this is first answer. Now look here. All these calculations we have done. Now another method of solving this is incremental approach. Now what is incremental approach? Now look here. All of you look here carefully. So here we have total sales, correct? Here we have total sales. Okay. So from total sales, can we calculate incremental sales? So incremental sales is the increase in sales. So either you can calculate 6,30,000 minus 6 lakhs, 6,48,000 minus 6 lakhs, 6,75,000 minus 6 lakhs, 6,90,000 minus 6 lakhs. This is what exactly they have given in the question. In the question, if you read, this column is incremental sales. So in the solution, they started with incremental sales. And they calculated incremental variable cost, incremental fixed cost. So here what we are doing is method 2, alternative solution. This is called incremental approach. So in incremental approach, I am writing the same pro forma, particulars, present, CPA up to D, and then I am writing incremental sales. Here 0, here it is not applicable. Here 30,000. Lalita, can you help with numbers? Here 40,000 or 48,000? 30, 48, 75, 90. This is incremental sales. Now, less. Incremental variable cost, less. Incremental fixed cost. Total incremental cost. So, now tell me what is incremental variable cost here?
2 rupees, 60,000.
Excellent. 2 rupees into 2 by 3. So, it is 20,000. 32,000. 50,000, 60,000. How it came? Because selling price is 3 rupees, variable cost is 2 rupees,
2 rupees.
total variable cost is sales into 2 by 3. Do you agree with me?
So these are units.
Illama, units means divided by 3. So 30,000 divided by 3 rupees is 10,000. 10,000 units. 10,000 units into 2 rupees.
Okay, sir.
20,000. So this is nothing but sales column into 2 by 3, na?
2 by 3. Yes, sir.
Divided by 2 will give you, divided by 3 will give you number of units. Multiplying with 2 will give you variable cost. So fixed cost remains same. Okay, so total increment cost is only variable cost. So when you do this plus
20,000.
this, obviously only variable cost will come. Okay. Now look at the solution carefully. So here they have taken incremental credit sales, then they subtracted incremental variable cost, then they have calculated incremental fixed cost, which is 0. Then they have taken incremental bad debts. So bad debts. Incremental bad debts. So when you go to your first calculation, here you have calculated bad debts. So from this bad debts, now they are calculating incremental bad debts. That means whatever the calculations in your mind or logics in your mind you have done for alternative 1 solution, same thing you need to repeat in alternative 2 also. So now that the pro forma is there on the screen, you can say what is incremental bad debts. But when you are solving it yourself, taking pen and paper, you need to, even if you start with alternative 2, you need to calculate bad debts in all the columns, and then only you can calculate incremental bad debts. So now tell me what is incremental bad debts? 9,450 minus 6,000. How much it is? Is it 3,450? Then 12,960 minus 6,000. Is it 6,960? Then it is 20,250 minus 6,000. Is it 14,250? Then it is 27,600 minus 6,000. 21,600. So guys, all of you, did you understand incremental bad debts? Say yes in the chat box. Very good. Very good. So they have taken incremental bad debts. Now incremental profit. Incremental profit. Okay. So this is going to be my incremental sales minus this is going to be my incremental cost minus this is going to be my bad debts. So if I calculate like this is my total incremental expected profit. This is my incremental expected profit. Now, based on this, we can write a conclusion. Based on incremental approach. Oh, wait. No. We need to calculate opportunity cost also. How can we write conclusion here? Less opportunity cost. So we take incremental debtors into rate. How do we calculate incremental debtors? First, let us take debtors. So here we calculated debtors. Okay. How do we calculate debtors? Take total cost, incremental debtors. Take total cost into credit period divided by 360. This step we have done in working note 2 previously. So take total cost from same working note, 4,50,000. See, I'll tell you one simple logic. Okay. Here, this is your debtors. This is your debtors. When you apply 20%, it becomes opportunity cost on debtors. So now we need to calculate 4,50,000 into 30 by 360. So Lalita, can you tell me 4,50,000 into 30 by 360, how much? Hello.
30 divided by 360.
Enta, how much it is?
37,500.
How much?
That is 37,500.
37,500. Correct? Adi, this is present column. Next, here, how much it is?
Next.
4,70,000 into 40 by 360.
52,222.
50 to 200.
22.
Okay. Next one is 482 into 50 by
4,80,000.
360. 4,82,000.
66,944.
66,944. Huh?
Yes, sir.
Okay. Next column, is it 5 lakhs into 60 by
5
360?
lakh to 60.
How much?
83,333. 5 lakh 10,000.
5 lakh 10,000 into?
75 divided by 360. 1 lakh
Okay.
6,250.
1 lakh 6,000.
250.
250. So this is debtors. This is debtors. Now, opportunity cost on debtors. Now, first we need to calculate incremental debtors. Incremental debtors is equal to this minus this. Here, this minus this. This is debtors in future. This is debtors at present. This is debtors in future. This is debtors at present. So this is incremental debtors. Now, opportunity cost on incremental debtors. This into apply 20%. So guys, all of you read this particular part which is highlighted and please let me know you understand it. Please calculate, please read this particular part and let me know if you understand it. Hello, do you understand this? Lalita, you understand this more? Net benefit is equal to A minus B. So this is incremental profit A. This is incremental cost B. This is net benefit. C is equal to A minus B. So this is A. This is B. Okay. Now, based on this column, we'll write conclusion. Based on this column, we'll write conclusion. Everybody is saying yes in the chat box. I'm happy you're understanding it. First time, if you're doing all these calculations, it will be little clumsy. Pavan sir, what all these calculations are kind of, but trust me, it is not actually a difficult thing. It is easy. So now tell me conclusion. Based on incremental approach, it is advisable to adopt policy A, which means credit period 40 days, since the net benefit is maximum. Then there is one more third approach also. If you understand this, we'll go to third approach. Okay. So this is alternative 3. So what is alternative 1? Total approach. What is alternative 2? Incremental approach. What is alternative 3? Calculation of actual return on investment from debtors and comparing it with required rate of return. Okay. Now I am writing here incremental debtors. I am writing here incremental debtors. So here, this is incremental debtors. This is incremental debtors. Okay. Here I am writing expected profit on incremental approach. Expected profit on incremental approach. So what is expected profit on incremental approach? That means incremental profit this much. This is incremental expected profit. So calculate return on debtors, which is A by B percentage. A by B percentage. So you know what is profit, you know what is investment. So return on investment is equal to profit by investment into 100. Simple. So this is your investment. This is your profit. This is your investment. This is your profit. This is your investment. So by applying credit policy A, how much I'm investing more? 14,722. By implementing credit policy A, how much of more profit I'm getting? 6,550. So what is return on investment? Can I say it is this divided by this as a percentage? So I got 44.49. So guys, can you calculate remaining percentages and tell me? Lalita madam, say hi in the box in mic.
Yes.
Do you understand how I calculated 44.49?
By expected profit divided by incremental debtors into 100. This is
Yes,
it.
correct. So tell me second column
9,040.
how much?
30.70.
Okay. Then
10,750 divided by 45,833. It will be 23.45.
okay.
1,400 divided by 68,750. It will be 12.22%.
So which one is best?
It will be that yes, 44.49.
Same answer. Whether you follow alternative 1 or alternative 2 or alternative 3, your answer won't change. Your calculations and logically how do you frame the answer, that is changing, but at the end your conclusion will be same. Here also we read the same conclusion.
Yes,
Based on return on investment in debtors, it
yes,
is advisable for the company to adapt policy A, credit period 40, since the rate of return is highest. That is what we do. So look at the answers. 44.49, 30.7, 23.45, 12.22. That's all. So this is alternative 3. So everybody understand all the 3 alternatives?
sir.
Are you sure? Everybody, please let me know in chat box. Beautiful. Lalita, can you read next question, please?
XYZ Corporation is considering relaxing its present credit policy and is in the process of evaluating two proposed policies. Currently, the firm has annual credit sales of 50 lakhs and accounts receivable turnover ratio of 4 times a year. The current level of loss due to bad debts is 1,50,000. The firm is required to give a return of 25% on the investment in new accounts receivable. The company's variable cost is 70% of the selling price. Given the following information, identify which is the better option.
Okay.
Present
Continue.
policy and present policy it is 50 lakhs. Policy option 1, 60 lakhs. Policy option 2, 67 lakh 50,000. Accounts receivable turnover ratio is 4 times. And the present policy, in policy option 1, it will be 3 times. Option 2, 2.4 times. Bad debt loss is 1,50,000. Policy option 1, 3 lakhs. Policy option 2, 4,50,000.
Super. So, present sales are given.
50 lakhs. Credit sales are 50 lakhs.
Yes. Then the percentage variable cost is given.
70% of the selling price.
Okay. So, do we have fixed cost in this question?
Loss due to bad debt.
No. Bad
Sales
debts is a different thing. Do we have any fixed cost in this question?
No, sir.
No. So, how do we calculate opportunity cost now?
Opportunity cost will be sales minus only variable cost will be the
Yes,
opportunity
only
cost.
variable cost will be taken. Excellent. So, shall we do problem number 16?
Yes, sir.
Illustration number 16. Particulars. This is present. This is policy option 1.
And policy option 2.
Okay. Now, sales. Tell me, what is present sales?
Present sales is 50 lakhs.
Next.
Sales
60 lakhs. Next.
67 lakh 50,000.
Very good. Okay. Next, they have given less variable cost, 70%.
70%. Yes, sir.
Okay. So, this
50
into
lakhs, it
70%.
is
Can you tell me how much it is?
35 lakhs. It will
Very
be
good.
35
Next.
lakhs.
Uh-huh.
And 4 lakh 42 lakhs.
Okay.
47 lakh 25,000.
Hey, you have ICI study material in your hand. You are looking at the next
No,
page
sir.
and you are telling.
No, sir.
Nijan cheppu. Are you sure?
Yes, sir.
Okay. So,
Expected benefit
expected benefit A.
15 lakhs.
Okay. Expected benefit A, 15 lakhs.
18 lakhs.
Mm,
60 lakhs minus 4. Minus
you
4.
can you can take bad debts also here, or you can write profit column here also. We'll write bad debts. Bad debts, how much, ma?
Bad debts.
They have given any bad debts? Here 1,50,000
Bad
they have
debts
given.
1,50,000.
Okay, here 1,50,000. Here how much?
Bad debt 1 lakh, 3 lakhs and 4 lakh 50,000. 4 lakh 50,000.
Now write expected profit here. How much?
15
Sales minus variable cost
15
minus bad debts.
13 lakh 50,000.
Okay.
15 lakhs.
Okay.
Minus 4 lakh 22,000.
Is my calculation correct?
20 lakhs 2,000.
Hello, everybody. Are my calculations right?
Yes, sir.
Then opportunity cost. This is B. Net benefit C is equal to A minus B. Then working note. 1. Opportunity cost. Variable cost of working. So opportunity cost is equal to
Total cost.
variable. No, not total cost. Variable cost into variable cost into
Rate, expected rate of.
Ako. Credit period divided by 360 into rate of return. Rate of return how much? 25%. But Pavan sir, credit period is not given, Pavan sir. Why? Then how do I do? Credit period is not given, but they have given turnover ratio.
Turnover ratio 4 times.
So
360
if
divided
turnover ratio is 4 times, what is credit period?
360 divided by
Excellent. 360 by 4. How much it is?
90 days.
So credit period, it is 90 days. And here, 3 times.
360 divided by 3. 120 days.
Okay. Then 2.4.
150. 150 days.
Okay. Very, very good. So then calculate opportunity cost. So can I say present?
Variable cost. 35 lakhs into
Very good. 35 lakhs into
2 times. Rate policy.
how much?
90 days. Divided by
90 divided by 100.
90 divided by 360. 360.
Okay. 90 divided by 360. Then
Into 25%.
25
Into 25%.
by 100.
Percent.
Okay. 25% means 25 by 100.
35 lakhs into 16 into 25%. 12 lakh 18,750.
First one.
Yes, sir. Into
2 lakh 18,750. Is it right?
yes, sir. Maybe 360 into 3 lakh 50,000.
Okay. Next one.
47 lakh 25,000 into 150 divided by 360 into 25%. 4 lakh 92,188.
Your calculations are too fast, ba. How come you are calculating faster than MS Excel? Sir, from childhood, I am like that, sir.
No, sir. I'm your student.
Oh. Normally, wherever I teach, whether it is online or offline, I call some student Akka. But
Okay.
today, when I'm calling you Akka, I'll tell you one fact. I really have a sister whose name is Lalita.
Okay.
So, you are really my Akka today. 49, 21, 88. Now, can you calculate net benefit?
Minus 4 lakh 18. 11 lakh 31 to 50.
Mhm.
11 lakh 50,000. 57.7 minus 4 lakh 92. 10 lakh 82, 18 and 12.
So, which one is better conclusion?
11 lakh 50,000. Option 1.
It is advisable to adopt
Option 1.
policy option 1,
1.
that is 120 days credit period, since the net benefit is high. Yes. So is this the answer we got? 1131 250, 1150, 10 lakh 80 to 812? Yes. Are these the numbers we got?
Okay.
Yes. So we are done with this question number 2 also.
Yes.
Guys, everybody, do you understand second question? If you understand second question, in the chat box, type 2, yes, 2, yes, 2, yes. Then we'll go to next question. In next question, they have a small other concept called pre-tax, post-tax. Not a difficult one. Very good. So, Mem Saab, read next question. Oh, hello, Lalita madam.
Hello. Hi, sir.
Read.
A company is presently having credit sales of 12 lakhs. The existing terms are 1 by 10 net 45 days.
Wait. What is this? 1 by 10 net 45? What is the meaning of
If
1 by 10?
payment is made in 45 days, 10% discount will be given.
Uh-huh. Then,
Yeah, I think so.
no, Akka, you are wrong.
1% discount if 10 days.
Vidya is right. So, this means the normal credit period offered to customers is 45 days. To speed up collection from debtors, the company announced a cash discount policy. If a customer pays on or before 10 days, the
1%,
company will give how much?
1% discount.
That's all. So 1% discount, Lalita, what do you think? 1% discount is big amount or small amount?
Depends upon the amount sales.
See, it
1%
is
is
a
big
cultural
amount.
cultural thing. Okay, normally our textile shops, if you see, they'll say 70% Ashadam sale, Adi sale, 70% off,
Yes.
80% off. So this is stupidity. Okay, so any customer who has brain, you have to ask whether the company will have more than 80% of profit. If they are selling the product for 100 rupees, how can they give 80% discount? If the price is genuine, 5% discount is also big amount.
Yes.
But if they increase the price 2 times and then giving 80% is stupidity. But our people are like that. Look at these shops when they announce 80%, 90% discount. How many people will be there inside?
It will be marked.
Yeah, it will be
Yes.
like crowd will be like
It's
tsunami.
not. Yes.
That means people are idiots. Sometimes 1% discount is also very big amount. If the pricing and terms are good, genuine, 1% discount is not small thing. 1% discount is also a very, very good thing. Okay. So this is what it is. Now, madam, you tell me what is 2 bar 10 net 45?
If payment is made within the 10 days, 2% discount will be given. Normal credit period is 45 days.
Super. Now read the question from the beginning again.
A company is presently having credit sales of 12 lakh rupees. The existing credit terms are 1
You can call,
1% discount
you can read it 1/10 at 45 or 1/10 at 45. Both the ways are correct.
1/10 at 45 days and average collection period is 30 days. The current bad debts loss is 1.5%. In order to accelerate the collection process further as also to increase the sales, the company is contemplating liberalization of its existing credit terms to 2/10 net 45 days. It is expected that sales are likely to increase by 1/3 of existing sales. Bad debts increase to 2% of sales and average collection period to decline 20 days to 20 days. The contribution to sales ratio of the company is 22% and opportunity cost of investment in receivables is 15%. 50%, 80% of and 80% of customers in terms of sales revenue are expected to avail cash discount under existing and liberalization scheme, respectively. The tax rate is 30%. Advice: should the company change its credit terms? Agent 360 days.
A star mark important question. This question is repeatedly asked in ICI exams. Repeatedly asked model. Okay, now see, this 45 days is the credit period offered by company. 45 days is the credit period offered by company. Okay?
Yes.
But what is this average collection period 30 days?
The debtors are normally collected within the 30 days of sale.
No. Average collection period in this question is little different. So can I say that, here if you look at it, 50% at present, 50% of the people are availing discount. 50% customers are availing discount. That means, can I say remaining 50% are not availing discount? So for those 50% customers availing discount, credit period is 10 days. For remaining 50% of customers who are not availing discount, it is 45 days. So what is the weighted average of the credit period we need to calculate? We need to calculate weighted average here. We need to calculate weighted average credit here. So like, for example, 0.5 into 10 days plus 0.5 into 45 days. You understand my point?
Yes, sir.
So 50% of 10 days plus 50% of 45 days, we need to calculate. But normally ICI do not love students, but here ICI loved students and saying, hey, Lalita, please don't calculate weighted average. If you are doing that much of work, we are panic. We love you so much as ICI. So we have given average collection period to you, which is arithmetically wrong. But because they have given average collection period, so you take 30 days present, and they have given average collection period 20 days. So you take 20 for the future. So for first column, take 30 days. For second column, take 20 days, because in this question, ICI has given the data. If the data is not given, you calculate this is present. For proposed, customers availing discount, 80%. Customers not availing discount, 20%.
20%.
So you calculate it like this. You calculate it like this. How 80% into 10 days plus 20% into 45 days is equal to. Calculate and tell me.
80%. 8 plus
Hey, 80% of 10 is 8. 20% of 45 is 9. 10
9,
plus 9. No, 8 plus
10,
9.
17, 17.
17.
Yes, sir.
17 days. Similarly, if you calculate here, it is 50% of 10 days plus remaining 50% of 45 days is equal
45
to how
days.
much?
13.75.
Hmm? How much? I'm getting 27.5.
13.75.
Eh? 45 into 50% is 22.5 plus 5 ma. I'm getting 27.5. I don't know. You're telling some other answer. Is my mind working properly?
My baby. 22.5
You
plus
are at your
5.
house or you are in a hostel?
I'm in a house.
So where mind works faster? When you are at house or hostel or college or friend's house?
At
First you
college,
should
my mom.
no. First you should basically have brain. Then it works anywhere. No. Guys, 25.5, 27.5, is it right? Akka, tell me, Akka, is it right?
Yes, sir. 27.5.
So, in first column present, we have to take 27.5 days. In second column proposed, we need to take 17 days. So, you need to take
17 days.
27.5 and 17. But ICI has clearly given present it is average 30.
30 days
In
and 20
future, it
days.
will be 20. So, we'll take the numbers given. So, if they have not given average credit period, you will calculate it like this. Are we clear, guys? Everybody? Everybody, please let me know. Are we clear? Average collection period given 30 days, 20 days. Okay. Sales cheppama. Sales anta. How much is sales? Present 12 lakhs. Then Lalita, in future, what will be sales? Increased by 1/3. What is 1/3 of 12 lakhs?
4 lakhs. It will
Okay.
be
So total
16,000. 16 lakhs.
16,000.
12 plus 4, it will be 16 lakhs.
16 lakhs. Then bad debts they have given contribution ratio. Ayyo, they have given contribution 22%, but variable cost is not given. What to do?
Sales minus variable cost is contribution.
Yes. Sales minus variable cost is
Sales
contribution. So sales minus contribution ratio is variable cost ratio. So if contribution ratio is 22 out of 100,
100
can I
minus
say variable cost is 100 minus 22?
78%.
Yes. Variable cost. So I'll take this number into 78%. Okay. Then any fixed cost given in the question? No. So bad debts given in the question?
Yes,
Yes.
bad debt is
Present 1.5, proposed 2. I'll take 1.5% here. I'll take in future 2%.
22%.
So this is bad debts. Okay. Then can we calculate what is called
Expected bills profit.
expected profit? So sales
Sales
minus
minus
variable
variable
cost
cost minus bad
minus
debts. Bad
how
debts.
much? So this is A.
Mm.
Then opportunity cost. Okay, there
Into
is,
credit policy.
hello. Hold on. There is one more cost, beta. One more cost. Cash discount. The company is offering discount.
1% in the present and 2% in the proposed.
Yes. Yes. So,
Uh,
so cash discount is calculated like this. At present, what is sales?
At present, 12 lakhs.
But will you give discount on all 12 lakhs?
No, if payment is made in 10 days only,
Excellent.
then only
So how
1%.
many customers are paying, in that 10 days to avail? 50%.
50%.
For those 50% people, what is the discount rate?
1%.
Correct. Now calculate and tell me 12 lakhs into 50% into 1.
6 lakhs into 1%.
Hmm.
It will be 6,000.
Okay. In future,
In future, it will be 80%. Sales is 16 lakhs. 80% will avail this discount option, and 2% will be the discount rate.
beautiful. How much it is?
16 lakhs into 80% into 2%. It will be 25,600.
Correct. So opportunity now expected profit is you need to subtract this also. Correct?
Yes, sir.
Now opportunity cost. Take variable
Expected.
cost.
There
How much it is? 9 lakhs
not 36,000.
into what is credit period?
30 days divided by 360.
Excellent. Into what is the rate required? Rate required.
Get that 15%.
15% pre-tax. So we'll calculate at 15%. Then we will consider tax rate, whatever is given. So 15 by 100. How much it is?
11,700 for the present policy.
Mhm.
10,400 for the proposed policy. 10,000. 11,700.
So I'm getting 11,700 here.
And 10,400.
I don't know. Let us see. 10,400. Correct.
10,400.
So calculate net benefit. C is equal to A minus B.
Mhm.
2 lakhs 28,300, 2 lakhs 84,000.
Ah,
How come they got different answer? Bad debts 32. Yes, correct. Cash discounts 25,600. Correct. 1248. Correct. Everything is correct. Correct only, no? Opportunity cost is also correct. Oh, no. Wait. Important. So, first they calculated profit after tax, then they subtracted opportunity cost. Hmm. Hold on. Don't take opportunity cost here. So, here, what they have done is they have written this as expected profit before tax, then less tax 30%. Correct. Can you calculate 30% tax? How much? Oh, hello, madam.
88,320.
Okay. Then
What? 2,06,080.
correct. Then they are calculating opportunity cost. Who's that? This is stupidity. Hmm. Mhm. So opportunity cost is equal to, they have taken variable cost into, they have taken variable cost into credit policy divided by 360 into credit policy divided by 360 into 70% they have applied. Okay.
70% of 15.
I'll tell you. It is post-tax rate by 100. This is okay. This, the way how they have calculated is fine. So see, pre-tax rate is 15%. Tax rate given in the question is 30%. So post-tax rate is equal to pre-tax rate into 1 minus tax rate. So it is something like, cost of debt is equal to, you remember KD is equal to interest into 1 minus tax rate they have done.
Yes.
We used to do this in cost of capital chapter. You remember? So we'll get one pre-tax rate and then tax rate. So post-tax rate is equal to pre-tax rate into 1 minus tax. So in this question, how they have done, post-tax rate of return expected is equal to, post-tax rate of return expected is equal to 15 into 1 minus 0.3. That comes to 15 into 1 minus 0.3. Is it 10.5? How much more?
0.7. 10.5.
It should be 15 into 0.7. Is it 10.5%?
Yes, sir.
Guys, all of you understand this calculation? Post-tax rate of return expected is 15 into 0.7. That comes to 10.5. Let me calculate is equal to 15 into 0.7. 10.5%. So how you need to calculate opportunity cost? Take variable cost, apply this credit period, then instead of taking 15%, take 10.5%. So what is variable cost in the first part, 9,36,000. Into what is credit period?
Average 30.
Into what is post-tax rate?
10.5.
Tell me how much it is.
Hmm. 36,000.
Hello. I need answer.
8,190.
Ta-da! 8,190. Correct. So here tell me calculation proposed is equal to, how do I do this?
Variable cost.
12 lakhs 48,000 variable cost
into
into how many
credit
days?
in
20 by 360 into what rate?
10.5. 7,280.
You will not get the answer because I have put comma. So I think system will say get lost. Yes, I know system will say get lost, but we will remove these commas. System will say yes, 7,280. So here we write opportunity cost, which is B 8190 7280. Okay, so A minus B net benefit.
1,68,000 minus 8,000.
Okay. So can you calculate incremental benefit? If the
increase in the sales
proposal is implemented is equal to 1,98,800 minus 1,59,800. How much money?
38,990.
38,990. Yeah.
Yes, sir.
So conclusion. Since the net benefit increases by rupees 38,990, it is advisable to the company to implement the proposed discount policy, proposed credit policy, that is 2 bar 10 net 45. That's all, ladies and gentlemen. 38,990. Is this the correct answer? Yes, 38,990 is the correct answer. 1,59,810, 1,98,800. Correct. That's all. So with this, we have completed all the illustrations in ICI study material. There are only 3 illustrations. We have solved all the 3. Okay, and then there is only one more problem in this chapter, which is factoring. So other than factoring, we have completed debtors management. So at the end of the working capital management chapter, you have some practice questions, test your knowledge kind of practice questions. Do that. Questions, solutions are given. Check your answers, and I hope you will be able to get all the answers. If you are having any doubt, you can contact me anytime. So do you understand all the concepts, whatever we have discussed?